Welcome to the deep dive. Today, we're cracking open an old document, an investment firm's 2005 annual report. Sounds a bit dry, right?
Yeah, maybe a little.
But stick with us, because what's inside, well, it might just shift how you think about your money, about risk, maybe even past mistakes.
Absolutely. Our mission today is really to pull apart the Giverny Capital Inc.
Mm-hmm.
annual report from 2005. We're going to extract its foundational investment philosophy, look at some key strategic shifts they made,
Okay.
and uncover these timeless insights from the president, François Rochon. The idea is to see how these apply directly to your journey, becoming better informed, whether you're already investing or just starting out.
Right. So this isn't just about the numbers, the spreadsheets, and stock tickers. It's more about a mindset.
Exactly.
It's about seeing companies not as like lottery tickets bouncing around, but as actual businesses that you partially own. Okay, let's unpack this, starting with who Giverny Capital actually is.
Okay, so Giverny Capital started up July 1st, 1993. And what's really interesting, what sets them apart right from day one, is that the president, François Rochon, he always kept all his own money invested in the very same stocks as the partners.
So really skin in the game, as they say.
Totally. They are quite literally in the same boat. It aligns their interests perfectly. And by 2005, the firm had grown quite a bit, reached over 600 partners.
That kind of alignment, yeah, that's pretty rare. So given that commitment, what was the core investment philosophy, the thing guiding them? Because it seems, foundational.
Yeah, it really is. At its heart, Giverny operates on the belief that stocks are simply the best long-term investment, full stop.
Okay.
Their strategy, it really boils down to buying exceptional companies at fair prices. They fundamentally see stocks not as casino chips,
Right.
but as part ownership of real businesses. The core idea is that a stock's return will eventually mirror the underlying company's intrinsic value growth. And that's often linked to its return on equity, the ROE.
ROE. So how well the company uses shareholder money to make profit.
Precisely. Think of it as efficiency in generating profits from the money invested in the business.
That's such a clear way to put it. So they're hunting for businesses with like sustainable, high margins, high ROE, strong long-term prospects.
Yeah.
But also this huge emphasis on the people.
Yes, the management.
Brilliant, honest, dedicated, and altruistic managers. That sounds almost idealistic. How do they actually spot those altruistic people, the ones who love the business more than the money?
Yeah.
What are the practical signs?
That's a great question. Beyond the obvious things like intelligence and integrity, they look for managers who show this almost like obsessive passion for the business itself. It's less about their own paycheck and more about building a thriving enterprise. They believe managers like that are uniquely able to skillfully balance all the different interests, clients, employees, suppliers, shareholders.
Treating everyone fairly.
Yeah, treating them as they want to be treated. It's that genuine care for everyone involved that signals, long-term stewardship.
That's a powerful filter. And they set some pretty ambitious goals for themselves too, right? How did they measure success?
They sure did. Their target was to get an annual return 5% better than their benchmarks, and crucially, over any 5-year period.
5 years. Okay, so patience built in.
Right. And assuming the S&P 500 would return, say, 6-9%, their projected annual target was around 11-14%. This wasn't just a number. It was a real commitment to outperform consistently over meaningful timeframes.
All right, so let's see how that philosophy played out in practice. Looking at the performance in 2005 and how their portfolio shifted. The snapshot for 2005 looks pretty solid.
It does. The Giverny global portfolio that's in Canadian dollars, it returned 11.5%. Its benchmark was only 3.6%.
Big difference.
Yeah, and the Giverny U.S. portfolio in U.S. dollars, that hit 12.5% compared to 4.9% for the S&P 500. But what's really key here, they point out, is that this performance was pretty much in line with the earnings growth of the businesses they owned.
So the business results drove the stock results.
Exactly. Their combined earnings were up about 13%, reinforcing that core belief.
That's impressive. Especially when you zoom out. Look at the long term since 93. Giverny Global, what was it, 19.2% annualized?
Yeah, 19.2% annualized versus like 9.8% for their benchmark and 9.6% for the S&P 500, all in Canadian dollars.
So a $100,000 investment back in July 93, that would have grown to over $800,000 by the end of 2005, way ahead of the S&P.
Massively ahead. And a key event that year, 2005, was this transformative federal budget in Canada. It got rid of the foreign content limit for registered accounts, like RRSPs, similar to a 401k in the US.
Oh, okay.
They call this the key event because it basically blew open their fishing pond, as they put it. It applied to all their managed accounts.
So they could invest anywhere for those accounts, too.
Right. Historically, those RRSP accounts made up about a quarter of the global portfolio, and they had to keep around 20% Canadian stocks. After the rule change, they dropped that Canadian content down to about 10% in 2005.
So this just opened up the whole world for them, which led to a big strategic shift, right? They dropped any country-specific targets?
Yeah, exactly. No more country asset mix policy. They decided to focus purely on finding maybe 20 or so outstanding companies, whatever their nationality. Just find the best businesses, period.
It sounds like a true best-in-class approach, regardless of borders.
Totally. They use this great analogy. Think of a hockey team general manager trying to win the Stanley Cup.
Okay.
Does the GM care if the best players are Canadian, Russian, American, Swedish? No. You pick the 20 best all-stars wherever they're from.
Love that. Simple goal. Best players.
Right. And the practical result was it simplified their reporting, too. Just boiled it down to two main portfolios: Giverny US and Giverny Global.
It's a powerful way to frame portfolio building. Now, what about currency? The report mentions the Canadian dollar was rising impressively, causing debates. How did they handle that, especially if it hurt some partners short term?
Yeah, that's a classic issue. Giverny takes this really deep, long-term view on currency. They basically believe it normalizes with the long haul, becomes an insignificant parameter, as they say.
Insignificant, even with big swings.
Over the truly long term, yes. And they highlight that trying to hedge against it is really costly. It could cost up to 4% a year.
Wow, that eats into returns.
Big time. That hypothetical 19% return since 93, it would have dropped to 16% if they'd hedged constantly. Sure, short-term effects can be huge. You mentioned some partners lost 26% on U.S. currency over 3 years.
Ouch.
Yeah. But over 10 years, that same effect might shrink a 16% return down to maybe 15%. The impact diminishes dramatically over time. It's a potent reminder about short-term noise versus long-term value.
That long view on currency really ties back to their whole philosophy, doesn't it? Seeing past the day-to-day noise.
Absolutely.
And speaking of cutting through noise, they put huge importance on something called owner's earnings, a metric to get at the real value. What is that and why is it so vital?
Right. Owner's earnings. The firm really emphasizes the underlying increase in intrinsic value, often shown by earnings per share growth, not just the short-term market price wiggles.
So business reality versus market sentiment.
Exactly. Because market sentiment can send prices soaring or plummeting randomly. But real business value grows from consistent underlying profits. It's like distinguishing the loud static on a stock chart from the quiet, steady hum of a profitable company.
Nice analogy.
They point out market performance can swing wildly short-term, like a 20% difference between 97 and 02 performance. But ultimately, it reflects the intrinsic performance of the businesses. And that's proof. Giverny's companies grew earnings by 14% annually from 96 to 2005.
Yeah.
That's double the S&P 500's 7% annual earnings growth over the same period. That's why they outperformed.
That clarity distinguishing business performance from stock price, so crucial for any investor. Let's pivot a bit to their market views and some fascinating behavioral stuff they shared. What was their take on the market back in 2005?
Well, in 2005, the Canadian market, the TSX, was doing really well. Mostly driven by energy stocks. They were up like 63% that year alone.
Wow.
Yeah. And energy's weight in the index ballooned from 15% to 30%. But Giverny sounded a clear warning. They said, look, cyclical businesses like energy, they have big ups and downs. These growth rates are not sustainable.
So, caution advised.
Definitely. They felt the TSX looked pricey at around 17 times earnings. That's the PE ratio. Especially with so much weight in cyclical stuff and banks. By contrast, they thought U.S. stocks looked more undervalued.
Really?
Yeah, the S&P 500 was trading at a more reasonable 16 times earnings. And get this, that was the same PE level as 7 years earlier, even though earnings were up almost 50% in that time.
Wow. That commentary from '05 feels kind of familiar today, doesn't it? The sector focus, the valuation question.
It often does. History rhymes.
And they stressed avoiding fads, emotions. The report flat out says the arguments for buying oil in 2005 sounded just like the tech stock arguments from 99-2000.
The same song, the same jingle, but with different couplets. That's the quote.
Love it. And a very blunt point. Patriotism is not a fundamental parameter. Leave emotions at the door when investing. It's so easy to get swept up, though.
Oh, absolutely. Which raises this key point about how we, as investors, get swayed by the latest story. They have this deep skepticism about market forecasters. They even quote Peter Lynch.
the legendary Fidelity manager.
Right.
Yep.
Lynch said, when it comes to predicting the market, the important skill is not listening, but snoring. The trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them.
Snoring. Okay.
Yeah. Both Lynch and Buffett basically said, ignore the headlines, ignore the forecasts, yet Wall Street keeps doing it. Why? Because, as Giverny says, this is what the client asks for. But they pose that critical question. If someone could really predict markets accurately, why are they still selling newsletters or advice instead of just being a quiet billionaire?
It's a great reality check, isn't it? And they connect this to something called the fog of the economy. What's that idea?
They argue the economy is just inherently unpredictable. Too many variables, known and crucially unknowable. They draw this powerful analogy from Robert McNamara's documentary, The Fog of War.
About Vietnam.
Yeah. McNamara said war is just too complex for any human mind to grasp all the variables. Giverny says the economy, while obviously less tragic, is similar in its complexity.
So trying to predict it is kind of futile.
Pretty much. The big lesson is, don't bet your financial future on things that are fundamentally unpredictable and uncontrollable. It's almost humbling, right? We spend so much energy trying to predict the inherently unpredictable.
So the economy is this dense fog, but they say there's good news in that fog, a way through it.
Absolutely. The good news is incredibly simple. Investing is just buying a piece of a business.
Back to basics.
Really. And if a business does well, performs well over many years, the stock market will eventually reflect that true intrinsic performance. It almost always does. To drive this home, they use this fantastic case study. Walgreens, over 25 years, 1980 to 2005.
Okay, this really brings the philosophy to life. Think about that period. Crazy economic swings. Interest rates from 2% to 20%.
Recessions, wars, oil shocks, deficits, you name it.
And the S&P 500 still went up 1,000%. That's 10% a year, even with 8 corrections and 2 big crashes in there. That alone is a strong case for just staying invested.
It really is. But during those exact same 25 volatile years, Walgreens stock climbed an unbelievable 18,000%.
18,000%.
That's a 23% annual rate. So if you'd put $10,000 in Walgreens in 1980, by 2005, it would be nearly $2 million.
Wow.
20 times what the S&P 500 gave you. It perfectly illustrates the Philip Fisher quote they include, if you are in the right companies, the potential rise can be so enormous that everything else is secondary.
Everything else is secondary. It makes you wonder, if these huge market swings and economic fogs don't really matter long-term for a great business, what should we actually be focusing on?
That's the question, isn't it?
Wow. That's just a powerful case for patience and focusing on business quality. And it leads perfectly into their own case studies, the hits, but also the misses. Starting with that brutally honest 5 years postmortem, looking back at the year 2000.
Right. March 2000, the absolute peak of the tech bubble. Giverny made some major portfolio changes then. They sold stocks they thought were just too pricey.
Yeah.
Names like IMS Health, Cisco, Disney, HP, Intel, even JDS Uniphase.
Big tech names back then?
Huge. And at the same time, they bought stuff they saw as undervalued, like Berkshire Hathaway, M&T Bank, Lincare Holdings. This was, as they put it, definitively against the crowd. Remember, lots of people thought Buffett had lost his magic touch around that.
I do remember that. So what happened?
The results were pretty stark. The stocks they sold. Over the next 5 years, they produced an average return of negative 53%.
Oof, minus 53.
Yeah. The stocks they bought, positive 128% on average. So those changes proved quite positive, as they modestly put it.
Quite positive. Understatement. It really shows the power of going against the herd when things get frothy.
It really does. And they then walk through their holdings as of 2005, sharing these interesting stories behind them, showing how they kept applying that philosophy.
Like Disney, for instance. They sold it in 2000, worried about Eisner's leadership, too much diversification, maybe neglecting animation.
Right.
But they bought it back in 2005. Why? Because of the new CEO, Robert Iger. He came from ABC, Tom Murphy's influence, and he quickly refocused on core strengths, led to that huge Pixar deal, selling off things like the stores and radio stations.
It's a great example of how leadership change can totally alter a company's outlook.
Yeah. Or Walgreens again. They called it the best drugstore chain in the world. Kept performing EPS, up 14% in 2005. Pharmacy same-store sales growing at 9%, double the industry.
And that aggressive expansion plan, right? Aiming for 10,000 stores by 2015. All with a clean balance sheet. It just shows their focus on consistent operational champs with clear growth paths.
And then there's Walmart, which
Yeah.
they bought in summer 2005. That Feels like a contrarian move, given all the negative press Walmart often gets.
Oh, absolutely. But they admired Walmart for things like its unmatched cost structure, the always low prices mantra, that relentless focus on long-term shareholder value.
Right.
Its international growth, especially China, they saw as a vast success. And they tackled the criticisms head on. Yeah, net margins are low, around 3%, but they argued employees were paid comparably like 10-hour average and got extensive benefits. They mentioned $4.7 billion for health and 401ks in fiscal '06 and pointed out Walmart was one of few U.S. employers offering part-time health coverage.
Interesting context.
And they highlighted that famous efficiency, the Pop-Tarts hurricane example.
Tell me about that.
Walmart's data systems noticed that before a hurricane hits, people buy more Pop-Tarts. So they could proactively stock Pop-Tarts on shelves in areas about to be hit. That level of supply chain mastery is just incredible.
Data-driven Pop-Tarts.
Right. And despite all the negative press, Walmart Canada was named one of Canada's best employers multiple times. So Giverny saw all that pessimism reflected in a 15 times PE ratio for a company growing maybe 12% annually as a great buying opportunity.
It's fascinating how a company can be so dominant, yet attract so much criticism. Almost like the market needs a villain sometimes. How does Giverny cut through that noise to see the underlying value?
I think it comes back again to that relentless focus on the fundamentals, the intrinsic value, that owner's earnings idea we talked about.
Right.
They held other strong performers too, like Payson Systems,
Yeah.
Canadian energy tech company, and ResMed, an Australian medical device maker, all chosen for strong business models, market share, good management, and reliable pillars like Berkshire. Even when Buffett was supposedly out of fashion, they trusted the value was still growing underneath.
That's quite a portfolio, really showing that focus on the business itself. Now, it's easy to talk about the winners, but what really makes Giverny stand out is their honesty about mistakes. What can we learn from their mistakes du jour? And how does this lead to their rule of three?
Yeah, the mistake du jour, they're very candid. They stress that often the biggest mistakes aren't the bad stocks you buy, the commission mistakes. They're the great stocks you don't buy, or don't buy enough of the omission mistakes.
Because they don't show up on your statement.
Exactly. They leave no trace, but the opportunity cost can be huge. The silent killer of returns, as they put it.
And they give three specific examples: bronze, silver, gold.
Yep, bronze medal, Gillette. They knew it well. Like the new CEO, James Kilt, bought some shares around $32 in 2003, but they hesitated, waited for a pullback to buy more.
Never came.
Well, the stock went up 60% instead, and then got bought by Procter & Gamble for $52. They missed out on bulking up. Classic case of trying to time the perfect entry.
Okay, that hurts. Silver medal.
Panera Bread. A friend recommended it. They did the legwork, visited a store, loved the food, loved the experience. But the stock was trading at 34 times earnings. Seemed expensive.
So they waited for a better price.
Yep. Waited for better price. The stock doubled. They never bought a single share. Shows the danger of being too rigid on valuation metrics, maybe.
Especially with growers. Okay, gold medal, the big one.
The gold medal, they call it a Lifetime Achievement Award in missing out. Starbucks.
Oh, wow.
They followed it from 1994 all the way to 2005. Watched it go up 1,800%. It's 30% a year.
Incredible run.
And never bought a single share.
Why? Because the PE ratio always looked high, consistently in the 40s.
Always too expensive.
Always. And the hard lesson they shared from this experience, the quote is, "Discipline is to respect one's own rules. Wisdom is to know when to break them."
Wow. That takes guts to admit. Discipline is rules. Wisdom is breaking them sometimes.
Wow.
That's very human. Even the best struggle with this. Absolutely. These stories really hit home that point. Sticking too rigidly to your rules might mean missing those truly exceptional, maybe even generational opportunities. And finally, this leads them to present their rule of three,
Right.
which is an empirical rule based on their actual history, meant to set realistic expectations for their partners.
So what is this rule, and how does it help, manage the emotional side of investing?
It's got three parts. One year out of three, expect the stock market to drop at least 10%. It happens.
Okay, prepare for downturns.
2, one stock out of three that they buy will likely be a disappointment. Not every pick works out.
Accept imperfection.
And 3, 1 year out of three, they will probably underperform the index. Even with their record, it won't happen every single year. This rule isn't just context for how partners should judge them. It's a powerful tool for mental resilience, for you, the listener, too. It prepares you for setbacks, fosters patience, helps you avoid overreacting when things inevitably don't go perfectly.
Yeah.
It normalizes the losing years, the losing stocks, as just part of the long-term journey.
What really stands out for me, wrapping up this 2005 deep dive into Giverny Capital, is just their unwavering commitment to that value philosophy. Focus on deeply understanding the businesses, cultivate extreme patience, and just tune out all that noise, the short-term market swings, the forecasts.
Seeing the forest for the trees.
Exactly. Recognizing that even with the fog of the economy, great businesses, their value will eventually shine through in the stock price.
And this perspective, it really invites you, our listener, to maybe reconsider how you deal with all the information overload out there.
Yeah.
Instead of chasing every headline, every prediction, could focusing on that enduring intrinsic value of the underlying businesses actually simplify your financial life and maybe lead to better results long term.
And those stories of mistakes, the omissions, especially Starbucks, it really hammers home that lesson. Wisdom is knowing when to break your rules. It leaves me with a final question for you to think about.
Yeah.
What deeply held investing rules might actually be holding you back? What might you be missing because something seems too expensive or goes against your usual checklist, even if it's potentially one of those truly exceptional opportunities? Something to mull over for your next deep dive.